Hello, everyone. Chad Krober here, your purpose-driven lender at Academy Mortgage. Hope you're doing well on this magnificent summer day and having a wonderful Northwest summer, as we always enjoy this time of year. So I'm wanting to provide a little commentary around economic activities and indicators that we have seen over the last month in June, and I always provide that a month later in July. So the Federal Reserve is taking a dovish tone in all of their commentary. So Jerome Powell and the other directors of the board, anytime they sit down for an interview, their terminology and the words they use are very straightforward, nothing to create any market reaction or incite any extreme commentary that would make us think or make the markets react that there is a big concern with what's going on in the current approach that they are taking in trying to help the economy recover from the COVID shutdown. And so as they continue forward in this messaging, we'll keep our ear attuned to what they're saying, but it's kind of this Goldilocks approach, not too hot, not too cold, just right in the middle, keep doing what we need to do to keep the economy firing up and starting up in a regular, healthy manner. The piece that is a little concerning for some folks is some are expressing that the consumer price index came in a little too hot in June, and then the year over year consumer or CPI reading came in somewhere between 4.5% to 5.5%. And some feel that's a little too inflationary. The Federal Reserve, however, is saying this is temporary because distribution channels and manufacturing channels were either shut down or reduced significantly during COVID. And so now they're trying to ramp up and catch up, and that has created these inflationary reactions in the marketplace. A prime example would be the cost of lumber. Lumber shot up during the spring months almost 90% higher. And then in the last month and a half, it has come tumbling back down almost 30 to 35%. And we're seeing it drop even more as manufacturers and distribution channels are catching up and getting the production of lumber back out into the marketplace for consumers and for builders. And so that's an example of what the Federal Reserve is referring to when they say, we believe that the CPI and these inflationary readings are temporary. We'll keep an eye on it and we'll see how it goes. Lastly, the mortgage-backed securities market. What's happening there? I'm going to hold up a little graph here that I drew that kind of gives you a nice visual, let me get the angle right here, of what I call technical moving averages, 25-day, 50-day, and 100-day moving averages, and then the 200-day moving average there at the top. What you can see is happening is that as these technical moving averages are converging, they're coming together. Let me get my angle right, looking at the camera. They're coming together here. And when they come together here in the next several weeks, we're either going to break through the 200-day moving average, or we're going to rebound off of it and come back down. If we break through it, if we go through the 200-day moving average and mortgage-backed securities begin trading above that technical indicator, we could see interest rates drop a little bit more. And, you know, it's hard to say if that will happen or for sure if it will happen, but keep it all in perspective. Historically speaking, anything in the mid threes, low threes, high twos, it's all phenomenal. And so we'll keep an eye on that and see how it goes, but it could definitely influence the markets going forward in the next several months as we head into the fall. Reach out to me with any questions that you might have about these matters that I've laid out here. And as always, if you have any mortgage questions, please say hello. Be glad to answer them and provide any information for you on your specific situation. Have a great day.